So if I had to start algorithmic trading from scratch in 2026, here is exactly what I would do. I'm Austin, founder of AlgoExchange. We manage over $70 million in live algorithmic trading capital with strategies that have been successfully trading year after year. Some of them even since 2018. But if I were starting today as a strategy user, not a developer, I would do things very differently than most people. So I'm going to walk you through my exact game plan that would save you years of mistakes and thousands of dollars in losses. Now, these aren't theories. This is what actually works in 2026 based on managing real money in live markets. And one of these steps in the framework is critical because it's about avoiding strategies that look amazing on paper, but are actually just ticking time bombs ready to destroy you. So by the end of this video, you'll have a complete roadmap to start algo trading the right way. Let's dive in. All right, so the first thing that I would do is I would get my hands on something that already works, ideally has a live or a walk forward track record. Now, you really want to avoid stuff that's just purely back tested. You don't know how legitimate that information is. It could be all curve fit, and the minute you start trading it in a live market, it could just be a total disaster. So if there's a walk forward or a live track record for a system that you could pay money to access, that is the path of least resistance to getting started with algo trading. Now, that is definitely the route that I would go, mainly because you could just start using a system that works, get familiar with the process of algo trading, because it's, for the most part, you're going to need to do something, whether that's manage a VPS or a server where the system is running, or if it has some type of web app or cloud hosted infrastructure, that's good too. If it's going to be web-based, you really need to get a good feel for the infrastructure that's going on behind the scenes. You definitely don't want to deal with any super high latency type systems that could cause just excess slippage and just be, overall not good, right? Just degrade performance from a lack of infrastructure. So you just want to avoid that. For the most part, it's probably going to be, something that requires you to use a VPS or a server and just get familiar with what that process looks like. Now, that stuff's super easy. It's really not that hard to do, but it's literally just accessing a machine remotely. It's really not that hard. So I would just get familiar with what that process looks like, get familiar with how a system works when you're not sitting there and actually approving every single action that it does. These orders are going to be all automated, right? They're going to be executed in an automated fashion. You're not going to need to sit there and babysit it. So that could be a new experience for most people. So I would just say find something that works, get your hands on it, deploy it, get familiar with the process. And then this is also going to be one of those things where you get to figure out what type of trading style you're comfortable with. Because when it comes to algo trading, yes, you don't have to sit there and actually place the trades yourself, but being a human being that values money, you're probably going to be checking the performance of that system. And if it's something that's a swing trading system, you're not going to be checking it every single day. If it's a more higher frequency system, and I don't mean an HFT system, but something that's day trading, taking a couple trades per day, you're probably going to be checking that on a frequent basis. And that just might not work for your overall personality, right? Some people are just control freaks and they just start freaking out whenever they see a little bit of red in their portfolio. Some people can handle that a lot better. Some people are better suited for swing trading systems. So just get familiar with the system that you're using. Get familiar with the trading style that best suits your personality, and overall just get familiar with, the infrastructure that goes into deploying the stuff. All this stuff really is not complicated. It's just a matter of, going into a new arena and doing it in a way that's the most efficient way for you. So rather than going out and coming up with a thesis and then actually building it into a set of rules and then having it programmed into a trading strategy and then backtesting it and then optimizing it and making sure you don't curve fit it and going through the entire process could be one of those things that's just not conducive to someone that's just trying to get started in this type of approach. So I would recommend finding something off the shelf that works, that has a live and walk forward track record that's independently verifiable, and then from there deploying it, getting comfortable with the process, and then we go on to step 2. So the second thing that I would do is I would avoid grid trading or Martingale strategies. Now, these are common risk management approaches in very low quality trash garbage systems that you definitely don't want to expose any money to. Now, these systems might sound like, or these approaches rather, might sound like a good idea in theory, but they are terrible in practice and will pretty much always lead to catastrophic losses. They might work for a period of time and then just go absolutely kapoof one day, right? It's usually when you least expect it, right? No one's ever expecting it to happen, but it's one of those things that's wiped out a ton of people that have done step 1, right? So step 1 was find something off the shelf that looks like it works and deploy it and get comfortable with it. There's a lot of people that have done that, but the problem is the systems that they got their hands on on were using either grid trading or Martingale techniques or both, and that ended up just wiping out their entire portfolio at a certain point in time. So this is one of those things that you could totally avoid just by vetting the provider and making sure that the systems don't incorporate any type of grid trading or Martingale approach. Now, if you can eliminate that from the equation, you are much further ahead than a lot of people that have done step one and gotten burnt. So that is part of the due diligence process, and also just one of those things on the checklist that if you're going to grab an off-the-shelf system, make sure it doesn't incorporate any of that type of stuff. Those are very dangerous practices, and you don't want to be involved in that type of stuff, okay? They're ticking time bombs that look good in the short term, but eventually blow up. All right. So find an off-the-shelf system that works with a live walk-forward track record, ideally that you can independently verify. 2, avoid any type of grid or Martingale-based systems. And then 3, only use a U.S. regulated brokerage. So if you are a U.S. citizen, only use a U.S. regulated brokerage. It does not matter if it is a USA-friendly country. I did a whole entire segment on this in another video on this channel, but it's just one of those things where you really have no purpose to sending your money offshore or overseas simply because you want to use an algorithmic trading system. There's plenty of great brokerage options here in America. We have federal agencies designed to regulate these brokerages to keep you safe. And this is another type of risk that you can completely eliminate just by doing things right in the setup process, right? So negligent strategy risk like grid trading or Martingale, you can completely avoid by making sure those techniques aren't used. The next type of risk you can avoid is the offshore and third-party custodian risk by just using a U.S. regulated brokerage. It's very, very simple. And there's a lot of big ones out there. You probably already have an account on some of them. Like Schwab allows futures trading, Interactive Brokers allows futures trading, and whether or not your system's futures or equities doesn't really matter. The main thing is that you just want to use a broker that's following the rules laid out for American citizens to be protected. Okay, these regulatory agencies exist for a reason, and that is to keep you safe, and you just want to make sure that your deposit isn't at risk. There's tons of horror stories out there where these offshore brokerages just disappear with people's money, and I don't want to see you be part of that. So make sure that you use a U.S. regulated brokerage, right? And also, you can always verify whatever brokerage you're considering using through the NFA basic search. You just go on the NFA's website, you look up the brokerage name, and it will tell you if they are an approved broker or not. If they're trading futures, it would be an FCM, or if it's going to be a Forex broker, they would be a Forex dealer. So they would be registered with the NFA in both cases. If it's going to be for securities or equities, then you would check through FINRA's broker check to verify the good standing of that brokerage firm. So far, we've covered finding an off-the-shelf system with a real track record. Number 2 is avoiding any type of dangerous negligent strategies like grid or Martingale. And then number 3 is using a U.S. regulated brokerage. Okay. Next thing I would do is I would only trade liquid and regulated products that have centralized clearing. So what that means, you're going to have data, but you're going to be trading products that aren't getting quoted different prices on different brokers. So there's a really common thing in the Forex CFD space where different prices will be quoted for different customers based on the brokerage they're using. And basically what that means is, let's say you're looking up the price of Euro USD, right? And you're doing that on TradingView. Well, you might see like 5 different brokerages that are quoting Euro USD, and that really just shouldn't be the case. So if you're going to be trading a product, ideally do it where there's centralized price data all going through one specific exchange, and then this way you're going to be trading a product, ideally that's also very liquid, so you can trade in and out of it very, very easily. Now, that is just going to be an infrastructural thing. I would just recommend that because it's just one of those things that you can just avoid some unnecessary, just inconsistency. That's just one of the things you just don't want to get into. So removing as many variables and moving parts just makes it less things that are going to be potentially broken. Okay. So when you just go the right way, find something with a lot more stability, and not only that, but a lot more regulatory oversight with good data, centralized clearing, all passing through one exchange. It's just going to be one of those things that allows you to be in a more, I don't want to say secure environment, but it is a more secure environment. It's just one of those things where you're going to have a more consistent experience with one piece of the puzzle, right? You should never have inconsistency with your price data. You should never have inconsistency with your trade clearing. You should never have inconsistency with your brokerage. All of those things should be like the absolute basics, right? So just by trading the right types of products makes this a lot more approachable. And those types of products would be something like futures, like NASDAQ and S&P futures, or equities like stocks that are trading through U.S. regulated brokerages. Now, this what I'm talking about, making sure that you have to, make these things very, very clear and apparent, is more or less in the currency pair space. If you're going to, have interest in a gold trading system, that would be a futures-based system as well. So just make sure the markets you're trading are being traded the right way. A lot of people want to trade currencies. There's nothing wrong with it. Trade the CME listed currency futures. You could do that. Now you have centralized clearing, you have transparent data. You're not getting quoted all these different prices from different brokerages. It's going to be one of those things that's a lot more consistent. So if you want to trade currencies, do it through the CME. If you want to trade gold, trade it through COMEX. And if you want to trade, NASDAQ or S&P, obviously do that through the CME. And if you want to trade stocks, trade that through securities brokers that are based here in America that are going to be obviously passing your orders over to the stock exchange. So there's really no reason to do anything with like any type of like weird offshore broker that's going to be misquoting you prices when there's ways to get, much better data and consistent price quotes and obviously centralized clearing. So that might have been a lot. If you're new to this type of stuff, you might be like,
what is this dude talking about?
But basically it's just a matter of having transparent data and transparent trade execution. So trading liquid regulated products on a single centralized exchange through a U.S. regulated broker is an absolute must and definitely something on the checklist that you must check off. That is a non-negotiable in my opinion. Now, when it comes to something more tactical, I would run multiple strategies at the same time. Now, this means you got to get your hand on a couple different systems. If you're dealing with a third-party provider, you don't want them just to have one system for you to use because that's exposing you to concentration risk. Now, what's the theme here, right? We keep talking about risk, right? Risk is apparent in markets at all times, and what your job is to minimize any type of external risk that you possibly can, right? Trade risk is always going to be a thing, but if you can reduce your concentration risk, your third-party risk, all these other types of risk associated with this approach to participating in markets, then you should do that. So I would definitely reduce my concentration risk by just trading multiple strategies at the same time. So you don't want to deal with any one-trick pony vendors. Ideally, if you're going to be dealing with third-party system providers, they have a couple different systems that you can choose from, and I would want to make sure that those systems are going to be uncorrelated. Okay, so at AlgoExchange, we have over a dozen systems that our users can access that we literally display the correlation matrix, show the relationship between all the different strategies so users can build uncorrelated portfolios, and that is the best way to do it. So ideally, you have at least 2 to 3 uncorrelated strategies, and the reason you want to do this is simply because no single strategy works in all market environments, right? You might have a system that crushes it in bull markets, suffers in bear markets, or vice versa, right? It doesn't matter really what the example is or what the environment may be. You want to have an approach to be able to navigate those different types of environments successfully. So there's really no such thing as a magic bullet. In my opinion, diversification is the closest thing to it. So the more strategies that you can expose your capital to that have low correlations, the better the situation you will be in. Okay, so that's what I would recommend for that. Now, moving on to the next thing is I would recommend and demand that you find real validation for your strategies, right? So if the strategies that you are going to pursue are going to be third-party provided, then I would want to make sure that those systems have actually ran in live markets and you're not just getting fed back-tested data. Now, what is a backtest for those of you guys that are new here? Backtesting is essentially a historical simulation on a data set showing you what would have happened. Now, backtests are great. They give you an idea of, what could have potentially happened in the past. But the thing about backtests is that they could be curve fit. Now, a curve fit is essentially when you manipulate the parameters of a strategy to give you the best possible outcome on historical data. And the issue with this is that it just doesn't hold up in live trading. Now, that's not to say that backtests are worthless. It just comes down to how it was generated. So ideally, if somebody is giving you a backtest, they are able to tell you how much of that data set is out of sample versus in sample. Now, in sample data, you could consider it your training data. It's what the model is pretty much developed and trained on. And then out of sample is the unseen data that the model is exposed to in the historical environment. So let's say, somebody gives you a 10-year backtest. Ideally, maybe 1 to 2 years is in sample, and then 8 years is out of sample. And ideally, that out of sample is in the front and in the back of the data set. So this way you can really have an idea of how did the strategy hold up, before it was trained and then after it was trained, on these parameters. Ideally, that parameter testing window is going to be very small and in the middle, and this is going to be able to give you a more reliable gauge of how it performed historically. Now, this is one of those things that you still need to take it with a grain of salt. If you are looking at a backtest, make sure it includes commissions and slippage. Make sure it covers at least 5 years of data, ideally with 80% of that data being out of sample. And then whatever the results are, take the results and to grade them by 20%. And if you're still okay with using that strategy, then I would consider potentially using it. So backtests are not worthless. They're just one of those things you have to be very careful with them. You have to make sure that they're largely out of sample, make sure they factor in, all of the real world, situations such as commissions, slippage. If they're using limit orders, you obviously want to make sure that it could be essentially a worse price, because when you're backtesting with limit orders, it's going to give you the best fill possible. And that market doesn't work that way in real life. So you want to make sure that if, whatever system generated that backtest factored all those types of things in to make it as realistic as possible. So this way, you're not getting duped by the time that you go to actually start trading it in a live market and it doesn't perform anything like it did historically, right? So that's why the live walk forward historical data is best, because it's actually going to, show you something that's indicative of real market conditions, something that's actually happening without training. It's just one of those things that, hey, the model's already been backtested, however, long ago, and now it's just been running, and now you're actually able to see, the real results for it. That is going to be a hell of a lot more valuable than a backtest, even if a backtest has all of the traits that we just described into making it a lot more credible. That is going to be, a very, very big thing there. So that pretty much is, going to be a lot of the main things there. I would just make sure that you clearly are going through all of those things. It's definitely not a one or the other. You definitely want to make sure that, the brokerage that you're working with is US regulated. You want to make sure the products that you're trading, obviously are regulated products and centralized. You're getting consistent price data. You want to get familiar with the environment and the way that you're trading. Obviously, if you're having to use a VPS and that's something you've never done before, it's probably a good idea to get your hands on that and learn what that experience is like. Again, it's very simple to do. It's literally just a remote desktop, but it's new, right? So when something is new, you want to get familiar with the process. You want to avoid grid trading and Martingale strategies. Just avoid any type of unnecessary risk in general. So Martingale, grid, forget that stuff. Just absolutely don't touch it if that's the case. Ticking time bomb is going to blow you up. Just a matter of when, not if. And obviously make sure the broker you're sending your cash to is going to be a credible and regulated brokerage. Trade liquid regulated products, so this way you could trade in and out of them very, very easily. Get access to multiple strategies at a time, so this way you can hedge them against each other. There's no such thing as a magic bullet. Strategies will suffer. They will go into drawdown at a certain point, and when you have a portfolio of strategies running your capital, you're able to hedge some of that other system drawdown with the other systems. Okay, and then obviously make sure that the track records that you're looking at are credible. So that is the main things that I would look for if I was getting into algo trading in 2026. At AlgoExchange, we have over a dozen trading systems, all with real walk forward track records. So if you're interested in getting your hands on those or learning more about how you could use those systems in your own accounts, check the links in the description, book a call with the team. We'll show you how it works and we'll see if it's a good fit. But hope you guys enjoyed this video, and I will see you in the next one.